So when you're searching online for a trading strategy, probably the number one thing that comes up, whether it's TikTok, YouTube, or any course that you buy, is going to be smart money concepts. And when you do look around, whether it's the biggest trading influencer in the world, ICT, all the way down to your average 18-year-old Forex trader, everybody is utilizing smart money concepts. And even on my podcast, it's been a hot debate where we've had some SMC traders, we've had some SMC haters, and both of them verified. In fact, some of the most qualified traders that I've had on the show, whether it's a Wall Street trader, a number one prop firm trader, or traders that have made millions of dollars from the markets, or prop firms, saying SMC doesn't work. And then we have other traders who are equally as qualified saying SMC is the best way. So as someone who's trying to make trading a career and wants to become a full-time funded trader, most likely, you'll be thinking, is SMC worth my time? As a trader yourself, my advice is look at the evidence. Because the great thing about the markets is a strategy is just an opinion and the truth is the markets. Now fast forward to 2025, where basically all new retail traders are looking towards ICT or SMC, or utilizing derivatives of it without even realizing. I can now more confidently say that it does not work. In fact, what I've noticed in the last few years is SMC zones are getting targeted and manipulated. In fact, one of the most viewed videos on this channel is going through dozens of examples of smart money traps without cherry picking, just walking through price action in a couple of weeks. And if you look at my public signals over the last year and a half, where I've profited over 55% in live call outs, I can say confidently that over 30% of my trades were utilizing smart money traps liquidity as my entry drill. So this video is not about bashing on SMC. This video is me saying that inducements, something that I swear by, something that I think is the most powerful thing in the market. Number one, because it exists every single day. Number two, because it defines the daily cycle, or every major move has an inducement within it. And number three, I've built an edge around it that has helped me make millions of dollars, and I've proven it with track records publicly. And lastly, it is not a correlation-based factor. It is the essence of the market. Real moves happen in the market with volatility and liquidity, and those things are defined by valid inducements. It's the oxygen of the market. It's never going to change. It's never going to go away. And therefore, this edge can never decay because you're trading with primary first drivers of the market. And to put this into perspective, what I want you to visualize is that an inducement and a smart money sweep, an ICT sweep, can look very similar. And that's the problematic part, because when traders take a loss on an SMC zone, sometimes it goes in their favor and they get a great high risk reward trade. Other times they get smoked out of the market and they don't know why. So the average trader just says, oh, I am using inducements. Oh, I am using SMC sweeps. They are the same thing. And sometimes I have winning periods. Sometimes I go 10 losses in a row and blow my account, and I don't know why. The simple fact is, if you take all of the sweeps that exist, all of those SMC FU candles, that is going to be in the larger pool of runs of liquidity. Or more simply put, not every SMC sweep is an inducement, but every inducement is an SMC sweep. Confusing, I know. This is why we're making this video. So what does your typical SMC zone look like? It's simply a case of usually equal highs, double tops, a rejection on a Fibonacci level, something that is going to be inviting in retail traders. And that's what smart money traders think is different, that they are different to retail traders. Little do they know, they end up as the same liquidity pool. And what they'll wait for is that zone that is built up, that equal highs that has built up. They'll wait for a price to go higher. Now, the reason they'll be doing that, the logic is sound, that this resistance level, this level of equal high where you're going to be seeing rejection candles, dojis, is going to be building into the narrative of resistance. Maybe it's on an EMA level, maybe it's around a supply level. We know that stop losses are going to reside above. And also what's going to happen is when price does come higher, you're going to invite people that are going to see this level of resistance turn into support. They're going to see buyers come into the market based on a break test and then continuation where the stop losses are going to be in this area. Not to mention also the buy stops that are going to trigger as these stop losses are taken as price breaches higher. So there's a lot of things that happen when price raids an obvious level. And the thing that really makes it a shakeout or a run of liquidity is that when price eventually does come lower, not only taking all the stop losses in this area where you had the previous resistance that has been raided out, you also ended up grabbing a bit of liquidity when you took out the buyers that were seeing a breakout of a zone, a simple break test continuation trader, pattern traders, and so forth. Now, when you have price coming into this area, what are SMC traders going to be doing? They're going to be seeing this level of supply because it was a sweep, a run of liquidity, and they're simply going to be trading a rejection off that. So they're going to wait for price to come higher, whether it's Fibonacci based, whether it's just supply and demand, whether it's an order block or whatever the reason may be, but they'll be looking to sell in this area. And the reason they're going to be doing that is because they're also going to be seeing a channel of liquidity building here. Maybe you'll see a little bit of temporary rejection over here also. You'll be seeing micro runs of liquidity, minor inducements as we call them. And this is going to be a very typical SMC pattern. And to be honest, at times that will be working just great and something that I utilize myself, because you have to realize this is also the same as an inducement, because when we look over here, we have a buildup of liquidity, a run of liquidity known as an inducement, and then you have the mitigation before the continuation. That is the definition of a liquidity liquidity cycle that I pioneered. And when you have the liquidity cycle and then you have an SMC formation, on first glance, they're the same thing. And certain of my trades that you may have seen me take, or certain of the case studies that you've seen us break down in detail, you'll be thinking, yeah, that is just simply a run of liquidity sweep. I learned that with ICT or SMC, wherever you learned that from, and it's the same thing. And you lose all of the nuance of seeing the difference between. Think of yourself in the markets as a scientist, as a surgeon. Precision counts, detail counts, data counts. All of these things are not just simple patterns, not just generic overviews. You have to understand the reasonings behind it, the science behind it, the data behind it, the psychology behind it. The market goes way deeper than just surface level patterns, because there's a lot of stakes. There's a lot going on when 10 pips in the market moves, because billions of dollars are interacting in that area. A lot of people's decisions, a lot of people's money, a lot of people's psychology. None of these things are just patterns and accidents. So how can we differentiate between an inducement and an SMC sweep? Let's get into this now. So number one, the problem that is going to arise is that when you have a pattern like this, we have to realize from an SMC perspective, yes, we've had a equal highs run of liquidity sweep and a bearish move, so therefore we should look to sell. However, what they will fail to realize is that market structure might be saying another thing, where you might have bullish move over here and then you might get a bullish continuation higher. Why? Because price has not actually broken structure. Price has simply come to a demand area and it has done a higher low, higher high, where we have higher low in the market, higher high in the market with a bullish breakout, coming to the demand area to make a higher low and then going on to make a higher high. So if you don't understand that simple trend, then you'll obviously get lost in this area thinking it's a supply zone because it looks like a pattern of a sweep. So that's going to be a major way that you can just eradicate a lot of losses, because another consideration could be multi-time frame analysis. If we are coming off a higher time frame supply zone, then obviously this area has more weight to be selling than going bullish. However, if we are coming off a higher time frame demand area down here, and price has not only just come up to this area and created this temporary consolidation and then come higher, therefore making sense to continue this trend, this being maybe a minor inducement of that to continue higher, makes a lot of sense because we've come from a higher time frame demand area. More importantly, how did price arrive to this area? Because this could have also been a build-up, inducement, mitigation, and this is therefore the inducement that is fueling price to come higher off this demand. So you have demand, therefore trend, and you have inducement, and you're just having a bullish follow through, and you've simply just taken a higher high in the market as a supply zone and you sold at a higher high instead of buying into the higher high. Basic market structure. When you have to align multiple time frames, session intentions, daily cycle variations, market structure, liquidity and inducements, when you factor all of these things in, you realize if you're playing the pattern game, you are simply trading like a fool because you're trading blind. You're hoping that your simple patterns of equal highs, run of liquidity is some sort of edge, and you're going to be throwing that to the markets willy-nilly, coming to each day in the market, hoping you see that pattern and hoping that's going to lead to a trade. And you think you'll be a little bit more sophisticated because you're waiting for your equal highs to be a 2-3 touch, or you're waiting for that sweep to happen, taking the liquidity of an EMA, taking the liquidity of a trend line, taking the liquidity of a Fibonacci level, and you're simply just not following the correct narrative. You're just trying to supplement lack of understanding with more liquidity pools because you're taking trend line liquidity plus equal highs, Fibonacci plus equal highs, EMA plus equal highs. Notice how it's just the pattern game all over again, and you're adding more coincidental things as opposed to understanding root causes of the markets. And that's exactly what we need to unpack. So you're not trading like a fool, you're trading like an intelligent investor and trader because you understand the intentions of what is a real inducement and how that can fall into the greater category of an SMC sweep. It's just the SMC sweep in general will mislead you, but the small nuggets within there of correct inducements will make you a lot of money. And you just have to know how to decipher the difference between an inducement and an SMC sweep. So an easy way to start to recognize these things is, where is the inducement of control? Is it coming off a demand area, and is there minor inducements along the way to show who's in strength? But if you have an inducement low and then you have an inducement high, potentially, I've made case studies on exactly this topic. I've shown multiple trades where exactly this is happening. You need to know a protocol when you have an inducement high and an inducement low, or a sweep high and a sweep low, who's in control. Then you layer in multi-time frame analysis, you layer in market structure. For now, a simple one, and the number one thing that is going to invalidate a lot of SMC sweeps is market structure. Aligning market structure with your sweeps to say that if you don't have a break of structure, you have not got a sweep. Meaning to say, if you have not got a break of structure, you have not found an inducement, you've just simply found a pattern and put that in the SMC category. Therefore, it's going to be a necessary requirement for you to validate an inducement that you see the law of cause and effect that you've seen me speak about many times. If you have a cause, which you've grabbed liquidity, it's liquidity that has trapped people out of the market, it's a market manipulation at a volatile time, it's a move with intention. That's how we define an inducement. It's a move with intention. If you have that cause happening in the market, you better have the effect, which is with all this new liquidity, with all this new momentum, with all this new volatility, if you don't even break structure, local structure, then that's a pretty weak sign to say there's no intention within here. So if you take out the immediate demand, not an internal break of structure, I like to follow full breaks of structure, then you have likely found a correct inducement and you can be looking to trade that accordingly. The next criteria I'm going to be seeing is what kind of a rejection do we see and what kind of a move do we have up, because momentum counts. The wicks count. The intention of the move, how violent it is, counts. If you have just a very minor consolidation and then price slowly comes up, that's not really an intenseful, powerful move. But if you have a long, drawn out consolidation, multiple touches, price is slowing down, so many people are seeing this zone of rejection, and then price very violently goes higher and then even more violently comes lower, you can see that is a heavily manipulated move because there's a lot of action, a lot of money, a lot of power going into these areas and very aggressive stop loss taking. So therefore I want to see price shooting up and then also very aggressively rejecting down. How can I read that? Look at the time. For example, if the average impulse up and then the average impulse down is happening over the space of an hour and then this is happening in the space of 5 minutes, then you know that you have momentum on your side. Another thing you can see is how much price is moving in a short duration of time. If the average price movement from high to low is 15 pips and this has suddenly moved 20, 30 pips, you have something on your side. My favorite one is going to be the intention within. Can I see large bearish candles with large imbalances to show me that there is intention and control in this rejection? And another cherry on top is going to be that you're going to see on a lower time frame, price is going to be doing minor inducements. As we go lower, it's going to be doing these minor inducements. After this main one, you're going to be seeing little ones continuing on that movement on a lower time frame. And the analogy I give is the domino effect. When you push one domino, your first inducements, you hopefully see a cascade of control, a cascade of other bearish inducements following through. If you don't see that, you only see one shoot to the high and then you're seeing bullish inducements or no imbalances or no intention or no large bearish breaks of structure. You're just seeing price goes up, price goes down. That could be just bullish control and you're just timing the market wrong, or you're just forcing a narrative in place. So you follow these things and it will definitely help give you clarity on what is a true inducement. So for now, the three main ones I want to give you is don't be selling a higher high thinking it's a sweep zone. Sell on supply zone, sell on bearish intent, sell after a break of structure. So you're going to be seeing multi-time frame analysis, inducement of control, imbalances to show intention, local market structure shifts to confirm it. And also then you bring in the whole category of the daily cycle, something I won't bring up today. That's other videos that I've made, but the daily cycle variations are certainly going to help you when you factor the Trinity and you factor in time of day. Is it in a key window? Are you taking key pieces of liquidity? Are you following an overall narrative, a daily cycle variation? These things will certainly strengthen to understand where inducements are going to happen and where traps are going to happen, where SMC traps lie. For example, a Frankfurt Open is a heavily manipulated smart money trap zone, a supply zone that is right above an Asia high liquidity pool. I'm talking 5 to 10 pips right above your Asia high buildup. That is going to be a heavily manipulated and trapped zone. So you need to know these characteristics of what daily cycles attack and how daily cycle variations print and prepare for the day ahead. So what I'm going to do now is walk you through 1 week of price action, just 1 week on EU on M1. That's all I'm going to do. I didn't pick a magic week. I didn't pick anything specific. By the way, you've seen me do this for more than 1 year on the channel with all the case studies, all the breakdowns, all the price action I've shown. This should be nothing new, but here's to summarize it all. So if we start off with here, 1 week ago today, and we look at how this session started off with a run of liquidity. If you see my last video, it was a full case study on this. So basically this took a higher time frame zone, hit a higher time frame supply, gave a rejection. So from there, we see the sellers take control. We have a bearish break of structure. Now let's read details, because this is where the SMC versus inducement stuff gets into place. By the way, I'm not saying this is an exact science. I'm not saying I'm a fortune teller or something miraculous. It's simply a case of I will also take losses. I will also misread it. Sometimes it's impossible to differentiate an SMC trap from an inducement. Sometimes it is the case and that just becomes our valid losses. But other times you can completely differentiate them and avoid a lot of losses that SMC traders will take, or just be trading in the wrong side of the market or trading in a completely reckless way. Sometimes it's not even a smart money trap. Simply it's just misunderstanding the market. Inducements will protect you a lot of the time. They'll keep you out of the market a lot of the time. They'll probably make you miss some good opportunities also. That's the price you pay for precision by trading with inducements that give you actually data edged, by actually giving you something that by giving you a confluence where data is on your side, and you actually have a smart system based on an edge, based on probability, data, and also understanding, as opposed to just pattern trading. So after that break of structure, we see the buyers take control. And how does that happen? We have a local buildup of liquidity, an inducement, a push out, a break of structure, all of these equal highs printed, and then price price continuing forward. So this was a valid one, but notice how this same zone has fulfilled its purpose. In a bearish market, we've had a small bullish inducement to show build up, inducement, mitigation. The buyers are in control, build up, mitigation. So we can see that these buyers are remaining in control and therefore they are serving a purpose. But when you continue higher, you see that price now starts to show bearish signs of control. We have this build up of liquidity, these equal highs getting swept, giving a bearish shift. Where does it land? Previous demand area. This is showing me sellers are not in control. And then this little sweep over here, this little run of liquidity becomes the fuel for price to target this previous supply zone. This zone is an SMC trap. Even though it has the same pattern of build up of liquidity, run of liquidity, break of structure, it's being countered by this inducement and therefore became a trap. It's Asia high liquidity also. And then when you see price take out all of this liquidity at 1 touch, 2 touch, 3 touch, price then takes that liquidity. That became the fuel to break this previous zone and therefore the sellers gain control. But then this became a smart money trap. And then you can see how certain zones serve a purpose to go lower and later on become liquidity. Other zones are just liquidity. So certain ones have a short duration of validity. Other zones are invalid from the get-go. And a great example of that is this previous area that was a complete valid cycle, a build-up, a inducement, a mitigation, a bullish push out. This area served its purpose now. The buyers were in control and then the sellers regained control with these inducements. Therefore, that zone eventually went on to fail completely by gaining liquidity, inviting in buyers, and then smoking the whole zone altogether. So you got to be on the right side of the market by understanding it, not just patterns. For example, this one, build up, inducement, push lower. Well, how do we call this one? Because it looks like another pattern. Is this an inducement or not? Well, then you have to look at the characteristics I was mentioning, time of day and so forth. This is right at the end of the day, so we're not going to be looking to trade that, but we can see it's a valid cycle. We have build up of liquidity, inducement, and then internal mitigation, push down, and then bearish all together. So this is showing me that that was a real intenseful move. And then we come to a high time frame demand area. Price now in Asia is building up this liquidity, Therefore, this became a smart money trap. Why? Because it's Frankfurt open, number one. Number two is not taking any liquidity. It's not even Asia high inducement, so no meaningful liquidity grabbed. And this was a case study that I made in the last video of a continuation model by understanding the real intenseful move. This is the inducement out of Asia range, and this is in our London window. Smart money trap zone became the liquidity to target for the real move of the day. This real move of the day is not an intenseful move. It's a temporary move because once we have this liquidity fulfilling its purpose, once this inducement has served its job, because we took out the smart money liquidity, we came to the previous supply zone that we mentioned, the valid one, and then we have another inducement, build up, inducement, mitigation. Now this guy is in control, so these areas are just going to be trapped. This is not a meaningful inducement. This didn't take a structure point. It didn't take a demand area. It's just a tiny M1 inducement within our Asia range. So eventually when this real inducement of the day takes over, because it's a valid liquidity cycle at a valid time, hitting a valid previous zone, then it's obviously going to attack this local temporary one and build out a narrative where this became the trap. So therefore this minor liquidity cycle of build up, inducement, mitigation became the fuel to attack it. So now we have the dominoes, the inducement of the day, the second domino falling, and the previous smart money zones becoming liquidity. Narrative counts, not the pattern. Moving on from that, this valid zone that we just mentioned, the liquidity cycle, later on can become a smart money trap. Why? The previous area of demand that's coming off the higher time frame demand, prices arriving back to it, all of that area can become liquidity to target. This is now hitting a demand area, so what do we expect? Buyers to take control. How do we see buyers are taking control? Narrative, and then we have build up, inducement, when bang on London open, pretty much on the minute, and that is going to be our intenseful move out of the Asia range. And what is the trap? This build up of liquidity here, those little equal highs, and this wonderful smart money trap on our Frankfurt open. This became the smart money trap. This became the real intenseful move because narrative of the higher time frame zone. When we come into that previous smart money zone, the one that actually led for price to come lower, that one has done its job. It served its purpose. Now it just became a place for smart money traders to get it wrong because they're seeing Asia high run of liquidity. Then we're seeing bearish, we're seeing bearish, we're seeing bearish, we're seeing maybe breaks of structure, we're seeing rejection candles, we're seeing left shoulder, head, right shoulder, we're seeing trendline liquidity. Smart money traders will have a million reasons to enter, but they won't look at the narrative to say, where is control? Maybe it's this inducement in our high time frame demand, this inducement to continue out, and we're waiting for the inducement of the day. So therefore, this whole area of equal highs, where we have 1 touch, 2 touch, run of liquidity, push down, this all became a smart money trap. Why? Because they didn't follow the narrative. They are simply just withholding market structure. Higher high, higher low, higher high, higher low, higher high, smart money trap taken out. So we can see that sometimes you just have to follow in the context and not just the patterns. Continuing on, what's happening here? Build up, run of liquidity, push out. Why? Because the buyers are in control. The dominoes have started to fall into place where we have higher time frame demand, Inducement number 1, inducement number 2 happening right here. And then what is happening the next day? The next day, which is actually today's price action, we have this same zone that was valid. Once it's reaching these highs, then we see, is it going to remain valid? And what we start to see is we have a build-up of liquidity, equal highs, hitting previous supply zones. So that's pretty interesting to see. And then we are seeing all of this bearish push down. We take out the previous smart money trap. We come all the way down here. Now we have context that matters, because is this supply zone going to be overpowering, or is this demand area going to be overpowering? Is all of this liquidity we grab going to be overpowering, or is all of this liquidity we grab going to be overpowering? Well, we look at the control, and when we read deeper, we see that this inducement is showing us control, and that's the most recent one. So as we arrive to this previous smart money zone that had a bearish push coming off a higher time frame supply, it gives a temporary reaction, minor inducement, and then we have inducements of control showing us that this is a smart money trap. Time of day helps, market structure helps, narratives help, minor inducements help. And that's where we find ourselves right now, showing us that the bullish narrative is taking control because these minor inducements helped us, and they took smart money trap liquidity here, smart money trap liquidity here. And when you zoom out and look at the whole thing, it's just 1 week of price action. It's not that long. We can see how there was valid inducements all the time. There was one here, there was 2, 3 here, there was another one here, another one here, another one here, another one here, a trade taken here, another one here. There's plenty of valid inducements, but you can also see how many smart money traps there are. There's one here, one here, one here, another one here, another one here, another one here, another one here. The price action in a single week is littered with dozens of valid inducements and dozens of SMC traps. So when you extrapolate this across the markets, across all the currency pairs, across all the time frames, across all of price action, you will see it can be very easy to mislead yourself, because if you're just following the pattern of equal highs run of liquidity, sometimes you'll nail it. Sometimes you'll actually find yourself trading an inducement without realizing it and find yourself a winning trade. And other times you'll be smoked out of the market and not realize it because you followed the plan. You followed higher time frame, you followed market structure, you found the equal highs and run of liquidity, and you still take a loss. Why? Because you didn't follow context, you didn't follow the rules I said of the inducements, and you're not building correct narratives or correct understanding. So my takeaway from this is, don't just follow the patterns, because if you follow the patterns, sometimes you'll get it right, and a lot of times you'll get it wrong. If you understand control, intentions, daily cycle variations, the trinity that I speak about, just go through this channel. There's so many videos where I break these topics in detail, so you don't find yourself trading random SMC zones and randomly blowing accounts and painfully trading for months and years and blowing account after account and not knowing why you're making any progress. But if you start to highlight only inducements, you will significantly increase your win rate, your risk to reward, your overall confidence, market understanding. There's so many benefits and profitability that awaits when you understand inducements. It is power in the markets, and it all lies in not just following patterns. It's following the restrictions to know what is an inducement. And that's why I always say a restricted trader is a profitable trader.